Good morning and welcome to this Wednesday, April 26th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we had a rough day on Tuesday, that's for sure. It did end a historical bearish period, which was good. That got that out of the way. But whether or not we can extend a rebound, we're getting a nice pop this morning in pre-market because of some great earnings out of especially Microsoft and Chipotle. Google, also nice report. And so we're getting a lot of positive reaction to those reports. And certainly that's going to help us at the open, but whether or not it helps us throughout the day and into the close remains to be seen. Right now, we do have Dow futures up 63, S&P 500 futures up 11, NASDAQ futures up 138. So on a percentage basis, NASDAQ futures up a lot more than the Dow and the S&P, obviously with the news out of some of these big companies from within the aggressive sectors. And that's always going to lift the NASDAQ a little bit more. Crude oil right now down about 50 cents a barrel. So we're back to about 76.60 per barrel. So we've been having a little steady downtrend there. And then the U.S. 10-year Treasury yield, 3.41%. We are up about 1 basis point this morning. But overall, that has been declining again. And that's something that we will obviously continue to watch as well. Let's go ahead. Give me 1 second and we'll take a look. Let me get this set up for you. All right, give me 1 second. All right, thanks for that. Dow Jones Industrial Average yesterday down 344 points. S&P 500 futures, or excuse me, S&P 500 down 65 points. NASDAQ down 238 points. So on a relative basis, you can see the NASDAQ hit the hardest yesterday. And when you look at that candle on these three major indices, you can see that was a very long filled red candle. And anytime you get that, that is selling from open to close. So there was no doubt yesterday was probably one of the worst days that we've seen of 2023, because not only was it a long filled red candle with increasing volume, but you can see on the S&P 500, we took out the 20-day moving average. On the NASDAQ, we not only cleared the 20-day easily to the downside, but went all the way back and finished within 14 points of the 50-day moving average. So we could have set up for a big move to the downside at the open today, especially if these earnings had not come through after the bell. But if it did come through, we are getting a rebound, and we'll see whether or not that sticks. Mid caps down 48 yesterday. That was almost 2%. And small caps down 30 points, which is 2.6%. So mid caps and small caps. Look at small caps going back down near the year low. And I know recently what I was looking for was a breakout above this high. Talked about small caps. If we got that trigger, if we got that breakout, doesn't really show it on this. Maybe I can let me make a note here, because I think that would be a good chart to go back and take a look at. Just going to make a note. We'll take a look at the IWM, which tracks the Russell 2000. So anyway, big move down there in the small caps, and you can see the AD line rolled back over again. It's just not nearly as healthy as these other indices. Mid caps not a whole lot better, but the AD line nearly set a new high. So that's at least one positive there. But both of these are rolling over with their PPOs below the center line. That's normally not a good look. So these are the two we really have to watch on particularly on a relative basis. They just have not been performing nearly as well as our the three major indices that we like to follow: the Dow, S&P, and NASDAQ, or NASDAQ 100. I like to follow the NASDAQ 100. Materials down a little bit more than 2% to lead the sectors lower. By the way, all 11 sectors were down yesterday. Technology down 2.13%. discretionary down almost 2%, energy almost 1.9%, and then we had industrials 1.84%. If you look across there, the three big aggressive groups I like to follow, technology, discretionary, industrials, all among the big losers, and then throw in materials and energy. Crude oil price has been coming back down. This is a little bit of a problem. I'm watching energy. I really thought the action on Monday was good for energy. Looked like maybe we were bouncing up out of a right shoulder, left shoulder, neckline, head, right side of the neckline, which was upsloping. So normally I would look for an upsloping right shoulder. At this point, because we didn't make the breakout above the neckline, we are still in this, or potentially in this right shoulder. I mean, I think we're okay down to about 82, but I'd really like to see that low form above the left shoulder, just because we've got that look, the rising neckline. I'd like to see rising shoulders as well. So maybe we get that 50-day, which is down at 83.59, but I really don't want to go much below that, especially don't want to go below 82. So that would be a level to watch. Now, we have had a lot of whipsaw action in energy throughout this year and really into the end of last year. So maybe it's just going to continue to whipsaw. It's not really giving us any clear-cut signs on which way it wants to go, which makes trading the XLE much more difficult. Much easier to trade a trend than to try and guess what's going on when you just continually flip-flop between strength and weakness. But the other groups, I mean, XLK, I want you to look at the AD line. XLY, look at that AD line. XLI, look at the AD line, all continuing to rise and set new highs, even though we haven't really seen breakouts. We did on the technology. We are putting in higher highs there, which is good. And that group's going to get another lift today from Microsoft for sure. At least at the opening bell, Microsoft, and we're going to go over that chart in just a little bit, but up rather substantially this morning. All right, 10-year Treasury yield. As far as economic reports out today, we did have the March durable goods. They were up 3.2%, which was way above the expectation, 0.9%. But one thing I've learned over the years with durable goods is you almost need to look at them over like a rolling 3 to 6 months, because month to month, they're extremely volatile. Last month, for instance, February durable goods was minus 1.2%. This month, plus 3.2%. I mean, they're just all over the place, and especially the transport. The transport portion of it can be very volatile. March durable goods, when we strip out the transports, only rose 0.3%. With transports, we rose 3.2%. So that's the difference that transports can make. The expectation, though, even if we strip out transports, was for a decline of minus 0.2%. So we did come in about 0.5% higher than expected. February, if we strip out transports, February came in down 0.3%. So we saw that flip and go positive 0.3. March wholesale inventory is really not much there. Estimate was for a rise of 0.2%, and we rose 0.1%. Looking at the 10-year Treasury yield, though, I mean, we're back in a downtrend. Now we're below the 20-day. I mean, the one thing I will say is we're below the 20-day, which is below the 50-day, and the PPO is negative. So at this point, I would give the edge to the fact that yields are likely to go lower. But we've seen this we've been seeing this for the last 6 months, 7 months, where we just can't continue a trend in either direction. I think it's pretty clear that the overall trend here is lower, but we get a lot of head fakes back and forth. My guess is that eventually we're going to see this go all the way back down to that August low. I don't know if it's going to be the next 2 months, the next 6 months, maybe over the next year, but I do believe that is the direction we're heading. And I think once the Fed recognizes, well, they've already started to recognize that inflation has begun to roll over and come back down, but they're remaining vigilant. They don't want to give up too soon or take turn their head away from it too fast. You know what I mean? So I think they're going to continue to talk tough and hope that does what needs to be done rather than actually raising. Will we get one more rate hike? I mean, it's possible. I mean, based on what I'm seeing, I wouldn't think so. We're now starting to see initial jobless claims moving up month after month. I think it's clear from a lot of the economic indicators that we are starting to slow. We've seen the jobs number come in a little less than expected. So I think they're going to stay put, but there are a lot maybe think we're going to get another quarter point. I don't know. We'll have to wait for that. But that's on the short end. That affects the Fed funds rate. What the 10-year Treasury yield, what these bond traders are looking at, number one is inflation expectations. The fact that we've been coming down now for 6 months tells me inflation's dead. It's behind us. And then you're going to start looking at the economy. If you believe the economy's slowing, you're going to jump into the bonds because profits are going to dwindle on the S&P. So you're not going to want to be in the stock market. You'd rather be in the bond market. I think you can do both. And I think that's probably what we're going to see. I think we're going to see money going into both bonds and stocks. And you're going to see the yield coming down. And those lower yields are going to help fuel valuations, especially on those growth stocks. That's why I think the market goes higher, the stock market. All right, moving on. S&P 500. There was the damage. And I mean, we're coming off the bottom in October. We're trending higher. I think this is a key high, key low, another new high. This stayed above this low. I still think as long as we stay above that 37.75 area, that we're still in an uptrend. So even because we haven't taken out this high yet. So we certainly could go back down to this low, which was 38.08. But I would say 37.75 remains the big low for now. The initial high, 41.75 or so, 41.80. But really, this is the one. So I'm looking at a little over 4,300 to the upside. So that's about 230 points. And then maybe 37.75 to the downside. That's maybe 300 points. We're sitting right in the middle of it. My guess, my money is on the market going higher. Many of you disagree. That's fine. Many of the same folks that are disagreeing with me now disagreed with me in June before we had the big pop. Disagreed when I said we were getting a double bottom in September before we've had this big rally. Maybe we go down again. Again, I don't think so. I don't believe that's the case, but anything is possible. We don't know all the news that's going to be coming out. I did like the earnings that came out yesterday after the close. Earnings are beginning to accelerate, and most of them are coming through and blowing away estimates. That's why I never follow these PE ratios that folks throw out there on the S&P 500, because every year they underestimate what the earnings are going to be. Every single quarter, it's like this. Maybe not every single, don't take me literally, but most quarters are like this. They talk earnings down going into earnings season. That's why we get that drop in the third month of every calendar quarter. And then as earnings season approaches and we start seeing some real numbers, the market goes up again. That's the way the market works. NASDAQ 100, that was a bigger drop, and you can see the volume escalate. It wasn't massive volume. I mean, we were coming out of this bottom. You can see the volume was much higher, up around 125 billion, 120, or excuse me, 1.25 billion and 1.20 billion. Here, we were less than a billion, but if you look back through the month of April, that was a pretty good volume day here as we broke down below the 20. So I don't think you ignore that. I'm certainly not going to rush out and sell everything I own because of that. And in fact, we were doing the exact opposite at earnings beats, and I'll talk to you about that in just a minute, because I thought this pullback would be viable. I expected the short-term pullback, but again, we'll talk about that in just a minute. Let's move on to the chart of the day. So Monday, Wednesday, and Friday, we issue at Earnings Beats a chart in our Earnings Beats Digest newsletter. And if you want to get that sent directly to your email, all you have to do is go to earningsbeats.com, scroll down, find this area right here in the middle of the page, and type in your name, email address, hit that subscribe button. We will send out the EB Digest to you 3 times a week. No credit card required. It is completely free. Hold on one second. It's completely free. And so you've got nothing to lose. I mean, it's a quick read too, by the way, 2 paragraphs in a chart. Probably from the time you open it to the time you close it, you might spend about 3 or 4 minutes. I mean, unless you want to spend more time, but you could literally read it, look at the chart, and be out in just a few minutes. So make sure you go over to Earnings Beats and subscribe there. So the chart that I featured today in the Earnings Beats digest was Citigroup. And I actually like Citigroup. I don't like the financials. I certainly don't like the banks right now. I think they're still going through issues, and I think the issues are going to take some time to iron out. Many of the smaller banks really, really struggling. We saw what happened to FRC yesterday, which was First Republic, San Francisco. Actually, let me just show you what happened to them. Big move down here. Stock went down almost 50%. This was on our list when we went through Q1 earnings last week with our members. Actually, it was earlier this week. This was one that I had put on my list that I wouldn't trust going into earnings. Not only did it go down when all the other banks went down, but it didn't just pull back 5, 10, 15%. This thing pulled back from $120 or $130 a share down to about 13 in, I don't know, 8, 9, 10 trading days. That's not normal. Obviously, there was a lot of worry about this bank. Now, we kind of went sideways. The banks recovered some. I mean, we started to bounce in the banks. And look at this little move here right before earnings. Probably had a lot of folks jumping in, back up at $16, and then earnings come out and you're back to 8. But they announced their deposits were way below what the market was expecting. Their customer deposits had fallen all the way back down to like $100 billion, which was way, way below expectations. So anyway, not a good looking chart there, but Citigroup was kind of on the other side. Citigroup looked really good going into their earnings. When I say really good, you look at this, you say, well, what do you mean really good? This is just going sideways for last year. That's not good. Well, it had shown tremendous AD through the end of last year and throughout maybe the first couple months of this year. So there appeared to be accumulation. We were near a 52-week high. And look right here, we were up near a 52-week high when the whole banking group was starting to go down. And so what we saw here over the last few months was tremendous relative strength. So Citigroup went down with the overall banking group, but look at the rebound this one's had. I showed you FRC where it barely budged. Wallstreet was using this as an opportunity to jump back in. AD line right back up near the high. Relative strength near 52-week high. So Citigroup, much, much better looking bank than FRC. I mean, and you just want to pay attention to relative strength. JP Morgan looks good. Citigroup looks good. I'm getting them confused. It's either USB or UBS. I think it might be UBS. Yeah, look at the relative strength on UBS. So just make sure you're looking, when you're looking at a bank, if you're thinking about a bank, for me anyway, I would not look at a bank that is continuing to show weakness and, was hammered in March and then continues to show relative weakness now. I want no part of it. All right, moving on. So we had an event last Tuesday for Max Payne. And the reason why, I think part of the reason why my voice is so rough right now is we have done so many webinars over the last 10 days. I've lost count. I'm now subbing for Dave Keller on the Final Bar. That's Stock Chart's flagship show at 4 o'clock every day. So now I've got 4 of those shows. I've done 2 of them, got 2 more to go. Once I get past Thursday of this week, I should be able to rest my voice a little bit, but it's been a combination, that and allergies. Allergies have been really getting me lately. Anyhow, we just got another 10 minutes or so to go. And like I said, I'm getting close to winding down all these webinars. So just keep pushing forward here. So with Max Payne last Tuesday, we have this event every month for our members. And honestly, it's critical. It is critical to at least be aware. If you're a trader, if you're buy and hold, Max Payne doesn't really mean much because it's a short-term directional clue. If you're a trader, you need this information. We sent out a week ago Friday, like 150 stocks to our members saying, this is where the current price is, and this is where Max Payne is. Be careful over the next week. That was a week ago Friday. Then we actually did a live webinar with our members on Tuesday evening. I want you to look at where, let's zero in on this chart a little bit. We'll do 3 months. Look right here. This was Tuesday evening. Do you see NVIDIA making this false breakout? Making a false breakout with a negative divergence as prices keep going up. This PPO has been dropping. So we got slowing momentum, false breakout. And then what if I told you, let me give you the number. On Tuesday, I did the calculation. NVIDIA on Tuesday had closed at 276 right here, 276.67. After trading up earlier that day above 280, by the way. Max Payne that I calculated on this stock was $236.51. Now, I'm not saying that's where NVIDIA is going. What I am saying is that if we did get down to that level, that's where market makers would pay out the least amount of option premium. As of Tuesday's close, I calculated NVIDIA, the total amount of net in the money call premium was $731 million. That's what, if we had closed on Friday at 276, that's what market makers would have paid out in total premium. And what we always tell our members is by the time Friday rolls around, or perhaps in the early part of the next week, we could see a move to the downside because every single dollar that NVIDIA drops will save market makers a small fortune. Every dollar. Even if it doesn't make it down to 236, if it just goes to 275, it saves money. If it goes to 274, it saves a little bit more. That was 276. Here we are 1 week later at 262. Now, what I said at the time was, if you owned NVIDIA, you could sell it if you want it. But for me, it was do not buy NVIDIA here. Why? Do I know for sure it's going to go down? No. But do I know the risks are elevated? Yes. I have a false breakout right there. I would be nervous about NVIDIA. Anytime you get a breakout, look at the volume pickup. We had a breakout on volume and couldn't hold it. That's not a good sign. Second, we had a negative divergence on the false breakout, slowing momentum. And then throw in Max Payne. Just beat me over the head. There's no way that you should have bought NVIDIA in the upper 270s. If you did, if you bought it on this breakout, I would have sold it when it failed on the breakout. Take a small loss. If you're aware of Max Payne. Now, here we are 5 days later. Would I be a buyer of NVIDIA? Yeah, as it pulls back, I would be adding positions. I love NVIDIA. I just didn't like it short term. Now, do all Max Payne candidates work? No. Here was one that I also thought was way overdone. Electronic Arts. And it kept going up. Look where it was on Tuesday. That close was 129.04. Max Payne was 119.83. Now, in this case, the net in the money call premium in this case was only 4 million. NVIDIA was 731 million. So obviously a little bit more incentive there, but still 4 million is 4 million. What happened? Not much. We went down on Wednesday, but by the end of the week and even through yesterday's close, we were fine. Didn't work. So does that mean I would ditch Max Payne? No. I think it's still a great directional clue. Does a negative divergence work all the time? Does RSI 30 mean a stock's bottoming? Does RSI 70 mean it's topping? No, it's a clue. Max Payne is a clue, but it's a clue that also involves market makers potentially making a lot of money, which is something I think maybe carries a little bit more weight than some of the other indicators. Let me show you the third one that I gave, though, as a potential short. This was Tuesday. Look at the false breakout. Look how much the stock had gone up. This was Riot blockchain. Stock closed on Tuesday of last week at 1345. Max Payne was 1039. That was a potential drop of 22%. Do you know where we were, the low on Friday, right near the close? 1052 was the close. 1050 was it wiped out. There was $21.5 million worth of net in the money call premium on Tuesday. Look at how that got wiped out over the next 3 days. Pretty useful information, I think. Anyway, we always pay attention. And Max Payne was telling us the QQQ and the spider had about 3 or 4% downside from Tuesday. And if we pull up the QQQ, there was the Tuesday. And I remember writing about it in the daily market report. I said, if we don't make this breakout here, you want to be really careful in the short term, because we had a breakout on the open. Put in a black candle, reversing candle, and look what happened over the next 5 days. Most of this, by the way, was driven by gaps to the downside. We had, I think, 5 gap downs. Excuse me, 5 gap downs in 6 days. But all but one of these had hollow candle. There was a big hollow candle the day before. So it was 6 out of 7. This was really the only day where we've seen a lot of selling. That was yesterday. Here, we did a lot of selling, but we stayed above the 20 days. So there really wasn't any technical damage. This one inflicted technical damage. So are we going to recover? I don't know. But anyway, this, when we did this, the QQQ, I had Max Payne at 306. Here we are a week later, 309.99 from 320. So was that directional clue worthwhile? I think it was. What I told members at the time was I got out of all my leverage up at the top, because I've been very bullish the QQQ. And when I think it's appropriate, I get into either the QLD or the TQQQ. QLD tracks the QQQ at 2 times. TQQQ tracks the QQQ at 3 times. So they're leveraged. Good news is you can make a lot more money. The bad news is you can lose a lot more money. So you really want to try and get it right as far as trend goes. So what I said was I was getting out there. And when you pull back, I said on Monday, I was starting to accumulate, and I would accumulate down to 311, 312 on the QQQ. And I was thinking 305 as a stop to move back out of the leverage. If it didn't work, you don't want to stay in it for very long. So when we went down to 309.99, all my buys were triggered. So I'm back into the leverage, and we'll see what happens. We're going to get off to a good start today. But I feel like the 305 area right in here, you can see that low is 305. Right in here, 304.5, 305. And then if we go back to, well, let me just stretch this out. Hold on one second. All right, let's go back and stretch this out to a year. If you annotate this chart, and just connect the recent highs, or excuse me, recent lows, you get a trend line right there. Where does it intersect? Right about 305, right at that low, right down here. I mean, you could hold off and maybe even after today's gap up, market just opened, but even after today's gap up, we could see a little bit of selling. And maybe we go back down to that 305 level. Just because we had a couple good reports and we gap up doesn't mean we're going to continue. We've been in this downtrend, and I could see potentially going back down again. I'm not convinced that this is just going to be a gap up and take off. It would look more like that if we can close back above the 20-day, which is right now at 314.46. Let's see where we are. So right now we're 313.24. So we gapped up. Let me show you the hourly chart here. This is what I'd be looking at. Can we get through? You can see where we've been failing at the 20. So is this just a morning move and then we're going to see selling for a while? It's very possible. I mean, we could go right back down. We're in a short-term downtrend. We don't see a positive divergence. So I'd love to see it go back right through the 20-day, obviously, but I don't know if it is or not. So you got to have your lines in the sand. For me, you can see that low right there down at 305. That would be one to watch. And you've got that trend line coming in. I don't know if 305 is the number, but that's pretty close to where I would be getting a little bit more nervous holding a leveraged ETF. And by the way, when I talk about leveraging, it's not like I'm selling my entire position in the QQQ and moving it all and taking this massive risk. I'm selling a portion of my QQQ, and I'm just trying to juice my returns a little bit if I'm right. If I'm not, I end up losing a little bit and exiting a little bit lower. But getting out at 320 and getting back in down 311, 312 was certainly worthwhile. It was worthwhile waiting, and part of that was because of Max Payne. We didn't do that work. I'm not sure if I wasn't aware of that, I don't know if I'd make the same trade. Or certainly I don't know that I'd wait for it to drop that far. Maybe I would still sell at resistance, but think about maybe getting back in at 318 or something on a quick little pullback. But Max Payne told me to have some patience here, and I think it panned out. Market has opened, but I just want to go through a couple of earnings reports with you pretty quickly here. Some big ones that reported. We can see what the actual reaction is now, but let's take a look at Microsoft. Gapped up, but it is pulling back. We'll see what that candle looks like. If this fails, we got a black candle right now. I mean, if it fails, we could come back down. If we do, the QQQ is going to drop back down again. This is a substantial portion of the QQQ. Google, I didn't like going into earnings. We did get the gap up. Look, it's already turned red. So that one I'm not overly excited about. Visa, I think, has been looking pretty good and had a nice up move. I like that one. Texas Instruments, not looking great on the chart. AD line didn't look bad, but just, I mean, we know how strong semiconductors have been this year, and we've just been going flat. This one's not keeping up, and now we see it going down with earnings. Not a shocker there. CMG, big report there, looking great, up 8%, $147. Remember when everybody jumps in at the open, market makers are on the other side, which is why many stocks will pull back after gapping up. If a stock can gap up and continue going higher in the face of market makers shorting, that tells me there's a tremendous amount of demand. I love stocks that gap up and keep moving up because odds are against that. Let's see, this morning, Boeing missed. There weren't many companies that missed. Boeing missed, but went up with earnings. That was interesting. Let me show you the other ones that missed. One was EQR, a miss here, and the stock is up. And Old Dominion Freight Lines, trucker, and this one did gap down, and it gapped down below support. We might see additional selling later today. We'll see how that one goes. Anyhow, let's take a quick look, see where we are on the market, and we'll wrap this thing up. Yeah, NASDAQ's back down. We were like, what, 1.1%, something like that. Now it's 0.83. I should have mentioned also Enphase. I mentioned in our Q1 earnings last week, on Monday, this was one that I did not like going into earnings. Enphase, it had been showing terrible relative strength or relative weakness in this case versus the renewable energy group. And now we see why. Stock getting hammered down 20%. Look at FRC down another 14%. So anyhow, that's it for me. Later today, 4 o'clock, I will sub for Dave Keller over on Stock Charts TV to do the final bar at 4 o'clock. If you want to join me, just come over here, click on Stock Charts TV link, and I'll give you the recap of today's action. Have a great day, everybody. Happy trading.